Hello everyone. Welcome to today's session on Goods and Service Tax filings. Today we are going to learn about the valuation rules under GST. In this session we will cover the importance of valuation under GST. Then we will see what is transaction value and what are the inclusions and exclusions from the transaction value. Afterwards we will see what are the challenges and complexities in valuation under GST. So before we proceed with this session, let us quickly see what we have done in our previous session. So in our previous session, we learned about the place of supply rules under the GST. So the place of supply under GST is the location where goods or services are ultimately consumed. Then we learned about the importance of place of supply in GST. So the place of supply determines which taxes are to be paid, that is CGST and SGST or IGST. Then the place of supply also determines the revenue sharing between the states. Then we learned about the place of supply in case of goods and services, that is in case of goods, if the movements are involved, then the place of delivery is the place of supply. Where no movement is there in the goods, then the location at the time of delivery is the place of supply. Next, we learned about the place of supply in case of imports and exports. So in case of imports, the importer's location is the place of supply. In case of exports, exports are treated as zero rated, hence GST shall not be charged, and it is by default considered as interstate supplies. Then we learned about the place of supply in case of services. So in case of services, to registered person, the place of supply is the recipient of such services. In case the services are rendered to unregistered person, the place of service is the address on record. Then if the address is not available for the recipient, then the supplier's location will be the place of supply. Then we also learned about the specific service rules, that is for immovable property, the property location is the place of supply. For restaurant or fitness spas, it's the place of service. Then in case of training, the recipient's location or else it is the venue. Then we learned certain more examples, like in case of goods transport agency, the recipient or the origin based on registration shall be the place of supply. Banking telecom sectors, the special address based rules are to be applied. Then in case of cross border services, where one party is in India and another party is outside the Indian borders, then in general it is the recipient's location which is the place of supply. In case of intermediaries, the intermediary's location shall be the place of supply. So let us now proceed with today's topic, that is valuation rules. So the goods and service tax in India is levied on the value of supply. This value is crucial for calculating the taxes payable and is determined by specific valuation rules outlined in section 15 of the CGST Act and the CGST Rule 2017. So what is transaction value? This is the value on which GST has to be charged. So the value of a supply is typically the transaction value, the price paid or payable for supply of goods or services when the supplier and recipient are unrelated, and the price is the sole consideration for the transaction. For example, a customer buys a refrigerator from an electronics store for rupees 20,000. Assuming they are unrelated and this is the only payment, rupees 20,000 is the transaction value on which GST is charged. So GST is levied on the value of supply. Any incorrect valuation of transaction value will lead to wrong taxes and compliance issues. That is, the department may charge the additional taxes along with interest and penalties. It is governed by section 15 on the valuation rules of CGST 2017. So what is transaction value? It is the price actually paid or payable for the supply. What are the conditions? The conditions are there must be unrelated parties and price must be the sole consideration. Forms the default method of valuation under section 15. So sole consideration forms the default method of the valuation under section 15. So moving ahead, what are the inclusions in the value of supply? So the inclusions are dealt in section 15 subsection 2 of the CGST Act. Certain elements, if not already included in the price, are added to the transaction values. Taxes, duties, cess, fees and charges under non-GST law, that is GST, shall be excluded. For example, a manufacturer sells goods for rupees 10,000 and separately charge rupees 500 as excise duty, then the GST value will be rupees 10,500. Then the amount incurred by the recipient on the supplier's behalf is also included in the transaction value. For example, if a supplier is liable for delivery but the customer pays the transport agency rupees 2,000, this amount is added to the value of supply. Then incidental expenses like commission, brokerage or packing charges at or before the time of supply shall also be included in the valuation of supply. For example, if a supplier sells goods for rupees 10,000 and charges rupees 500 for packing and 200 for transportation, the total value is rupees 10,700. Then interest, late fee or penalty for delayed payment shall also be included. For example, if a rupees 300 late fee is charged on a 30,000 supply due to delayed payment, the GST value becomes rupees 30,300. Then subsidies directly linked to price excluding government subsidies. For example, a private organization's rupees 2,000 subsidy on a 15,000 product makes the value of supply rupees 15,000. A government subsidy won't reduce the value. So for example, a private organization's rupees 2,000 subsidy on a 15,000 product makes the value of supply rupees 15,000. So a government subsidy would reduce the value. So moving ahead, we have exclusions from the value of supply. So exclusions are dealt in section 15 subsection 3 of the CGST Act. Discounts allowed if given before or at the time of supply and recorded in the invoice, or if given after supply based on a pre-supply agreement or linked to relevant invoices and the recipient reverses the input tax credit on such discounts. For example, an invoice for rupees 80,000 shows a 20% discount that comes to rupees 16,000. So the GST value is rupees 64,000. Next, a discount agreed upon based on reaching a purchase target after supply is executed if a credit note is issued and the recipient reverses the corresponding input tax credits, then it will also be excluded from the transaction value. Then government subsidies will also not be included in the value of supply, and pure agent reimbursement, that is out of pocket expenses reimbursed by the supplier, will also be excluded. Next, when the valuation rules shall apply. So when the transaction value cannot be determined under section 15(1), then the valuation rules shall apply. First, we have rule 27, where the consideration is not wholly in money. Valuation is based on open market value or the sum of monetary or non-monetary considerations if the open market value is unavailable or the market value of like kind and quality is not available. For example, A new phone with exchange has open market value if a price without exchange is available. If a laptop is exchanged with a printer of known value, that value is added to the monetary consideration. If these methods fail, Rule 30 or 31 may apply, such as using 110% of the cost. Next is transactions between related or distinct person. So related or distinct person, when transacts between themselves, then the value is typically the open market value or the value of like, kind and quality if open market value is unavailable. For goods for further supply, 90% of the price charged to an unrelated customer can be used. Otherwise, Rule 30 or 31 applies. We will see Rule 30 and 31 at a later stage. For example, goods supplied between related entities at a price lower than the open market value can be based at a invoice price if the recipient can claim full input tax credit. Related or distinct person, we have already covered this. Then principal agent transaction. So Rule 29 deals with principal agent transaction. Similar to Rule 28, using open market value or 90% of the agent's selling price to an unrelated customer is the value of supply. For example, a principal supplying groundnuts to an agent can value the supply at the similar price charged by another supplier to the agent or 90% of the agent's selling price. Then we have Rule 30 that deals with cost based valuation. So if other rules does not apply, then the value is 110% of the cost of production or cost of acquisition. For example, office chairs costing rupees 4,000 are valued at rupees 4,400, being 110% of rupees 4,000. This will apply if open market value is unavailable. Then we have residual method, that is Rule 31. Value is determined using reasonable, means consistent with the section 15 and the rules if other methods fails. Then we have Rule 31A, that is valuation in specific supplies. So provide specific methods for services like lottery, betting, gambling and second-hand goods. For example, of a second-hand goods, a dealer selling a second-hand car for rupees 3,50,000 bought for 3 lakh without claiming ITC values the supply at the difference, that is rupees 50,000. Next we have Rule 32 special valuation for services. So services like money changing services, fixed percentage or slab method is used. Then air travel agent, 5% or 10% of the basic fare shall be the value of services. Then life insurance, it will be 10% or gross premium method. Then second hand goods, margin scheme, that is just we discussed. Then for vouchers, it is the redemption value, or value will be the face value. So Rule 30 and 31, we have already discussed this residual method. Rule 30 implies cost of production plus 10%. Rule 31, best judgment if other methods fails. So let's see few case studies. Barter with part cash. In case of barter transaction with partly in cash, the open market valuation shall be used to determine the value of supply. Interbranch with full ITC. Invoice value is acceptable in case of interbranch transfers. Used car, we have margin scheme, that is the sale price less the purchase price shall be the value. Then airfare booking, that is 5% of the basic fare shall be the value of supply in case of airfare booking services. Then post sale discounts, it is allowed only if the input tax credit is reversed by the recipient. To summarize, transaction value is the default valuation in case of transactions between unrelated parties where price is the sole consideration. Next, include all incidental and financial charges. So the valuation rule includes all the incidental and financial charges under the value of supply. Use rules 27 to 35 only when required. Document basis of valuation for audit, that is whatever valuation has been done by the supplier of services must be documented. Ensure invoices match the actual value plus taxes. So before we conclude this topic, let us have a look on the checklist and few examples. So identify the nature of transaction and relationship. Check availability of market value or cost. Then use correct rules for special cases and maintain supporting documents. So let us go through certain real life scenarios and see how the valuation is done. So let us move to the examples now. Example 1, transaction value, which is covered by section 15 subsection 1. A retailer sells a smartphone for rupees 15,000 to a customer. This price is the only consideration and the parties are unrelated. So in this case, the valuation will be done as per section 15 subsection 1. The transaction value of rupees 15,000 is the value of supply as the parties are unrelated and price is the sole consideration. Next we have inclusion of incidental expenses. A furniture manufacturer sells a bed for rupees 25,000. Additionally, they charge rupees 1,000 for packing and rupees 500 for transportation. This is the FOB destination, fee on board destination. Then the valuation will be done. It will be like the value of supply is 25,000, that is the price of the bed, plus rupees 1,000, that is packaging, plus rupees 500, that is for transportation. The total price comes to rupees 26,500 and GST has to be paid on rupees 26,500. Next, inclusion of interest and late fee. A supplier sells goods for rupees 50,000 with a payment term of 30 days. That is, payment term of 30 days implies interest or penalties or demurrage charges will have to be paid after 30 days. So if the payment is delayed, a 2% late fee is charged. The customer delays the payment by 15 days, incurring a rupees 1,000 late fee. So the valuation in this case will be the late fee of rupees 1,000 is added to the original value of supply and the value of supply for GST becomes rupees 51,000. So the GST will be charged on rupees 51,000. Next, exclusion of discounts. First scenario, that is pre-supply discount. That is before the supply is executed, discount has already been given to the buyer. So a retailer offers a 10% discount on a product priced at rupees 10,000 during a festival sale. So the invoice reflects the discounted price. Here the valuation is the GST is calculated on rupees 9,000, that is 10,000 minus 1,000 discount amount, as the discount is given at the time of supply and recorded in the invoice. Next, in scenario 2, we have post supply discount. So a wholesaler offers a 5% discount to retailers who achieve a certain purchase target over a quarter. This discount is based on a pre-existing agreement. After the quarter, a credit note is issued and the retailer reverses the input tax credit. In this case, the discount is excluded from the original value of supply as the condition in section 15 subsection 3 are met, that is the recipient of input tax credit must reverse the ITC. Next we have considerations not wholly in money. This is dealt in rule 27. So a dealer sells a new refrigerator for rupees 30,000. and an old refrigerator is exchanged. The open market value for new refrigerator without exchange is rupees 35,000. So in this case, the valuation will be done on the basis of open market valuation, that is rupees 35,000. Hence the value will be 35,000. Then we have supply to related parties. Related party transactions are covered by Rule 28. So a company sells machinery to its subsidiary, company B. Company A sells machinery to its subsidiary, company B, for rupees 1 lakh. The open market value of similar machinery is 1,20,000. Company B is eligible to claim the full input tax credit on such purchases. So the valuation, if company B can claim full ITC, the invoice value of rupees 1 lakh will be deemed to be the open market value. If full ITC cannot be claimed, the open market value of rupees 1,20,000 would be the value of supply. Moving ahead, valuation for goods supplied through an agent. A principal supplies customized t-shirts to an agent. The agent sells these t-shirts to customers for rupees 800. The open market value of these t-shirts cannot be determined. So the valuation, the principal can opt to value the supply at 90% of the price charged by the agent to the customer, which is 90% of rupees 800, that is rupees 720 per t-shirt, and he will charge GST on this rupees 720. Then cost based valuation. Cost based valuation is dealt in Rule 30. A company manufactures a specialized product for which there is no open market value or comparable product. The cost of production is 10,000 per unit. So here the valuation will be done as per Rule 30, and the value of supply will be 110% of the cost of production, that is 11,000 being 110% of rupees 10,000 per unit. Next we have second hand goods. A dealer in used cars purchases a car for rupees 4 lakh without claiming any input tax credit. After minor repairs costing rupees 10,000, they sell the car for rupees 4 lakh 50,000. So in this case, the valuation will be done on the basis of difference between the selling price and the purchase price, that is rupees 4 lakh 50,000 less rupees 4 lakh, that comes to rupees 50,000. Minor repairs are considered part of the margin and not added separately to the purchase price for the purpose of margin scheme. And finally, we have valuation of services provided by an air travel agent. An air travel agent books a domestic flight for a client for rupees 5,000. The basic fare of the flight is rupees 5,000. So the valuation rules, the value of supply for the air travel agent is 5% of the basic fare, which comes to rupees 250, and he has to charge GST on rupees 250 and pay it to the government. So these all are the examples of valuation rules, and this brings us to the end of this session. So thank you very much.